What's going on, everybody? Today I'm going to show you the mathematics behind money. I'm going to show you how to use velocity and money to save you a whole bunch of it. In other words, I'm going to show you how to take back the banking functions in your life. If I was to ask you, is it possible to earn more when you're earning 4 but you're paying 6? So if you got a 6% loan that you're paying on, but yet you're earning 4% on an account, can you make more earning 4 when paying 6? I know the answer. You're all saying no. You're actually losing 2%. But that isn't the case. When you understand the velocity of money and you understand how interest rates work, the mathematics behind it, you will understand that you absolutely can earn more when you earn 4 and pay 6. It's all in how you do it. So that's what we're going to uncover today. Myself and Christy Van are going to really show you the truth about money, the truth about how velocity of money works, and how you can pocket more money yourself without working harder, longer, or taking on any more risk. Let's dive in.
Today, we have Chris Naugle with us, and he is going to be talking about the line of credit. Now, I talk about the line of credit all of the time when we're talking about leveraging the bank. But today, we're going to be talking about how to maybe leverage your own bank. Does that even make sense? Oh, wow, guys. When I learned about the infinite banking concept, not just, a really great place to store your money, but when you need that money, what does it look like when we take that loan from ourselves? I talk about not taking loans. And when I learned this one thing about using the infinite banking concept, and I learned that we're actually using our own line, I got super excited, and Chris Naugle is the one who helped me to understand that. Chris, I am so excited about what you're going to talk to us about today. Welcome back.
Hey, thanks for having me. And this is a really cool topic, one that I probably haven't talked about it enough, but you kind of had this idea. You're like, so it's a lot like a line of credit. And she's like, or you said, most of my clients understand a line of credit, but they have a hard time understanding the infinite banking concept. So all we're going to do is we're just going to explain the similarities, but the differences and why it's so much better.
All right, let's do it.
All right, so let me just start with some basics. I mean, everybody understands a line of credit. If you own a house, and Christy, I just heard a really unique statistic that I'd, mad at myself if I didn't bring it up. I was at a convention out in Puerto Rico, and the chief investment officer said, he's going through the things and he's showing the status of the economy and what's going on. He says, debts are at all-time highs. It's the highest level of debt per household in the U.S. I'm like, yeah, I know, it's terrible. Then he goes into another slide and shows delinquencies and shows the spike on delinquencies on debts. I'm like, bad scenario. But then he says this, and it threw me. He said, however, he said, that right now the debt to asset ratio is the lowest in U.S. history. So let me just explain that. Like what he's saying is, remember he said, we're at the highest levels of debt we've ever been. Delinquencies are at the highest. But he said the debt to asset level, so people's household assets are at the highest level as well. And it made perfect sense to me. So what he was saying is that right now, people are house rich and cash poor. All the money is locked up in their homes, locked up in 401ks, but their home and their 401ks rocking and rolling. I mean, the house is worth more than ever. The 401k is worth probably more than ever. So they feel good. So they got this sentiment that there's like a positive thing. But yet in daily life with inflation and the cost of groceries and everything else, it's like every month there's just not enough money in the account to do the things they want to do. It's like there's this huge parallel right now between assets and debt. And I think that's the best place to start is folks do have a unique opportunity right now with the equity in their house, or you could leverage your house. So let's just kind of write that up here. So the equity in your house is basically what we're talking about. So your house is appreciated in value. Maybe you bought it for 100 and today it's worth 200. So, you got $100,000 of equity sitting in the walls of your house. But that equity isn't paying your groceries. It's not making your car loan payment. It's not paying off those credit cards. It's just a feel-good thing. It's like, hey, my house is worth 200. I only paid 100. Woohoo! Don't get excited about that. It doesn't mean anything until you learn how to extract that. So this is lines of credit. So as we all know, if somebody has a house and they want to extract the equity portion of their house, the only way they can do that is a HELOC or a first lien HELOC. I'm not going to go into this, Christy, because you do such a great job of teaching this, but I think most people know that. In this case, if you had $100,000 in equity, a bank will typically give you about 80%, 70 to 80%. So let's just say you tapped into an equity or a home equity line of credit on your house. Great. How much right now are they charging in interest on home equity lines of credit? Like roughly?
An average is 9.25.
Wow, it's still that high. All right, so 9.25% it's going to cost you. I want all of you to remember 9.25%. That's an average. Even if it was 8%, wouldn't matter. So you want the equity from your house, you got to get a home equity line of credit. Now remember, this is a traditional bank that offers these. So when you borrow money from a bank in a line of credit or a HELOC, and I'm just talking HELOCs now, you have to make monthly payments to the bank. And you can do monthly interest-only payments, or you can do principal and interest payments to the bank. We all understand this, right? This is common knowledge. Now, let me go one step further. If you don't have a house, maybe you rent, no big deal. It's a very common thing, but you've done a really good job of keeping your credit high. So let's say you got a 700 plus credit score. Most folks with a good credit score and a W-2 wage or a good income can go out and they can just get themselves a normal line of credit and sometimes an unsecured line of credit, right? Christy, you see this all the time, don't you?
Yes. The average is usually about 15,000.
Okay.
So it's a good line.
So $15,000 you can get unsecured from a bank as long as you got good credit and good. So there's, I'm not going to go into what the bank requires, but you got to be bankable. Now, what are they charging for these unsecured lines of credit?
It can be 12 to 16%.
Let's go to the low end, 12%. Ouch. So 12%. So now up here, we got a home equity line of credit. So we get your house that secures this line of credit. So therefore, the interest rate's lower. And then down here, you got nothing securing it except for your good faith and your credit score, and you're at 12%. But both of these require a monthly principal and interest or monthly interest payment. So if you're just making interest payments, you're never getting ahead, but at least you got the capital to use. So now we all understand that, right? I want to go into some mathematics, and then I want to show you a better way to do all this. You see, the best line of credit, it's not called a line of credit, but the best way to use capital is by changing where it goes. Now, before I get into that, I want to show you something. I got this really unique calculator that we did. So math is a very funny thing. A lot of numbers here, but I'm going to keep it really simple. Math is a unique thing. In our video, in our 90-minute video, folks, we show an example of somebody earning 4% on a bank account or on any account, earning 4% and paying 6%. And in that video, I say, is it possible to earn more when earning 4 and paying 6? So can you pay 6% interest and earn 4%, but make more earning 4 when you're paying 6? That seems stupid. Most people are like, that is idiotic. Chris, are you a fool? Of course you can't make more earning 4 when paying 6, but you can, and you will if you understand math. This is what we're going to do right here. So let's just use just a regular line of credit example, $15,000. You go out and you get a line of credit, $15,000. Now let's just pretend that you found yourself a bank that only charges interest one time a year. You only have to make an interest payment one time a year. Therefore, you've literally got 12 months of time where you could knock that principal down. What would that do? So let's just use an example where you start off with a loan, and I'm not going to do 12%. We're going to just do 5%, okay? You start off with a loan at 5%. If you never paid any principal payments throughout the course of those 12 months, you would have indeed paid 5% to the bank or whatever institution it went to. But what if all we did is we used $15,000, okay, in this magic account where we only have to pay interest one time a year. Now, I think some of you are realizing this is not a bank because none of you know a bank that only charges interest one time a year. At least I doubt any of you know a bank because I've never seen one. They charge interest every single month, and you got to make payments every single month. In this scenario with this account, which in a second I'll tell you what this account is, you can make payments every month, but they only go to pay down the principal. So remember, we started with a $15,000 loan and we started at a 5% interest rate. So I'm cheating a little. It says 4967. That's because it's accounting for 1 month. Now let's just assume that for 12 months, we made $100 a month principal repayments. Let me ask you this. If you paid the principal down over 12 months, would you still have paid 5% interest to this institution? Christy, what do you think?
No.
No. In a line of credit, a simple interest scenario, you would not. You would have, at the end of 12 months, actually, let me make sure I got the 12th month here. There we go. We'll highlight this one over. This is your 12th month. You would have paid 4.783%, which is less than 5. Okay, so now let's just go down. Let's go down to the next category, which would be 24 months. Let's say you continued doing this and you did it for 2 years and you just made $100 principal payments. You would have only paid 4.7%. And you see, as we go down here, this number keeps going down and down. Now, I used a really small amount of money. Now, let's just say you took a $15,000 line of credit. Okay, you took that loan, but instead of $100, I don't know, let's say you did $500. I just want you to understand how math works here. So what we're going to do is we're going to put in $500 a month principal repayments, and we're going to do that just for 12 months. So you borrowed 15, you paid off a credit card, okay? You paid off a credit card and you took the $500 a month credit card payment that you used to give to Visa and you paid it back to this particular place, this line of credit. How much interest would you have paid? Well, if we started at 5, at the end of 12 months, sorry, I forgot to highlight it again. At the end of 12 months, which is line 18, you would have only paid 3.917. Do you see how that works? It's because what you're doing is you're knocking the principal down. They're charging interest only on the principal due, but because in this scenario, you owe no interest for the 12 months, you only owe the interest 1 time per year. You have 12 months to knock that down, and then your APR is significantly less. So remember back to that example in that video where I say, can you earn more earning 4 when you're paying 6? You absolutely can. We have calculators. This is one of the calculators that shows that. I'm just giving you an example that you didn't pay 5% here. You actually, in this example, paid 3.91%. Now, if I ask all of you, would you prefer to pay 5% to the bank, or would you rather give the bank 3.91? You'd all be thrilled to give the bank 3.91. Well, this is how you do it. You understand mathematics. Now, let me stop this. And now I want to go back and I want to show you something really special. So remember I said, you can't do that with a bank. I don't know a bank that does that. But what if you wanted to be your own bank? What if you no longer wanted to play the game that we have all been taught to play with banks, and we wanted to be our own bank? Well, if that was the case, and you said, yes, Chris, I want to be my own bank. Yes, Christy, I want to take back control of my money. Yes, Chris and Christy, I want to take back control of the banking functions in my life, which all that means, folks, is I no longer want the bank to be in control. I want to be in control. Here's how simple it is. It involves one change in your life. So there's some caveats to this. You have to be saving money today, and it doesn't matter how much you're saving, but you have to be keeping some of your income. This is the first law of wealth, if you all want to know that. Read The Richest Man in Babylon, listen to Earl Nightingale, even in the Bible. It talks about the laws of wealth in these. Earl Nightingale is the main one, and he says you must keep 10% of what you make. Now, I don't care if you're keeping 10%. It doesn't matter what you're keeping. That amount you keep, your savings, we're going to change where it goes. Now, you might be thinking, Chris and Christy, where should I put that money? This is where it's going to get a little weird for just a second. We're going to put that money in a specially designed and engineered whole life insurance policy from a mutually owned life insurance company that pays dividends. I know that's a mouthful, and you're probably thinking we're even crazier. You're like, I thought they were crazy a second ago. Now I think they're really crazy. These folks just told me to change where my savings goes, and they're telling me to put it in a specially designed whole life policy? Precisely. But let me explain why. You see, if you build a specially designed and engineered whole life, which, just so you know, you can't call the insurance company to get this. You probably can't call your life insurance agent. Your broke brother-in-law probably doesn't know how to do this. It's specially designed. You have to find somebody like myself or Christy that knows exactly how to design the whole life contract to do what I'm going to show you. But even if you did call us and you set up a call with us to do this for you, let me explain why you would want to do this. We change where your savings goes, and it goes into this specially designed whole life. Now, here's the reasons why. A whole life insurance policy, number one, pays you a guaranteed interest rate. So most of the policies that we write pay 3% guaranteed. Some are a little bit more, some are a little less, but 3% is a nice number. How many of you would like to receive 3% guaranteed interest for the rest of your life on your safe money? I mean, everybody's raising their hand. The bank might give you 3% today, but as soon as Jerome and the Fed drops interest rates, you're not getting 3 anymore. Here, it's contractually guaranteed to never change. But wait, there's more. I know it sounds like a sales pitch there. I hate that, but it's funny. So it's not just the 3% guaranteed the insurance company is giving you. You also get a dividend. So instead of 3%, what if you earned 5 to 6%? I'm just giving you ranges. That's the dividend crediting rate, which is the interest rate plus the dividend. This is how much you actually earn inside of the whole life. And because it's life insurance, because we design it so that it is still considered life insurance by the IRS, you're going to receive this dividend crediting rate tax-free. So right out of the hole, if you were asking why would I do this, that's why. That's far better than you're getting in a bank account. But now let's put practical application. Remember I gave you that example of that line of credit. So let's just say you had $15,000, okay, that you got from wherever, and you put that $15,000 into this whole life insurance policy. Okay, I don't care if you got it from a line of credit or wherever, you put it into this whole life. And then you immediately needed $10,000. We'll just use 10 grand. So you put the 15 in, and literally in the first 30 days, you wanted to pay off a credit card. So over here, we're going to make this opportunity. We're not going to make it a house. We're going to make it a credit card. Because a lot of people, like I said, are in credit card debt. And most credit cards are 20+%. So let's just do some math here. If you were paying 20% to a credit card, would it make sense to borrow from your HELOC at 9.25 to pay off a 20% credit card? Oh yeah, because you're making the spread, 20 minus 925. Down here at 12%, that unsecured line of credit. If you were paying 12 to the bank for the unsecured, but you had a credit card at 20, yeah, that's still an 8% spread. Remember I said you're going to make 5 to 6%. So let's just use 6% because that's a pretty easy number to get with a couple of the companies we do. You have a credit card that you owe $10,000. So we got a $10,000 credit card over here that you've been paying 20% to. What we're going to do is we're going to take $10,000 as a loan. I know this sounds crazy, but bear with me. You're going to borrow 10 grand from that specially designed whole life. Remember, the 10 grand, it's your money. You put 15 grand into this and you need 10 of it back immediately. So most people would be like, well, that's my money. Why would I take a loan for it? Well, here's why. If you take a loan from the insurance company, what the insurance company is doing is the insurance company is going into their general account and they're going to give you 10 grand of their money from their general account. It's a ledger deduction. But then what they're going to do is they're going to come down here, they're going to look at your death benefit. Let's just pretend that you got a $300,000 death benefit. That's only good if you die. But while you're living, the insurance company, because you have $15,000 on deposit, the insurance company is happy to give you up to pretty close to the $15,000. In this case, we only need 10. So they're going to just lend you $10,000 of your $300,000 death benefit while you're living. They're going to use your 15 grand in cash value as collateral. So for the insurance company, this is a good deal. They're collateralizing the loan that they're giving you from your death benefit. But here's the awesome part. You get to borrow that 10 grand at 5 to 6%. Simple interest. Remember, I just showed you a simple interest calculator. As we make payments, that APR, it wouldn't be 5 or 6. Let's even round up. Let's say you're making payments at 5.5%. That's your simple interest. But you're earning 6. Remember, when you took the 10 grand out to pay off the credit card. So now the 10 grand came over here. And we paid off this credit card. That credit card's gone. We paid it off. Now that credit card, let's say every month you used to pay $100 a month to the credit card because it was 20% of 10 grand. Got that? Well, we just paid the credit card off because we've had 10 grand in our policy. We borrowed it at 5.5% to pay a 20% credit card. Now that's even better than that HELOC. That's even better than that line of credit because the interest rate's lower. Now it's 5.5 minus 20. But hold on, if you were all paying attention, you just caught on to something. It's not really 5.5 minus 20. The insurance company's still paying you 6% dividend crediting rate. They're charging you 5.5. Hypothetically, your numbers will vary. So little disclaimer, your numbers are going to change and be different than what I'm showing you. I'm just giving you the concept. So you're making money on your money. You're doing what a bank does. You're making a spread. And then you're using the money to make another spread. So you literally, in this concept, are making money twice on the same dollar. But let's sweeten this pot. I showed you a calculator, but you probably have already forgot about it because now you're like whole life bad, now good, whole life good now, whole life good, used to be bad, now good. You're trying to articulate this whole thing. Now, let's go into the math. Remember, this credit card that you just paid off, you used to give them $100. So now we take the $100 you used to give the credit card and we recapture that $100. We just literally change the name on the check. It no longer says Visa, it says your name or the life insurance company's name. We put that $100 into the policy every month as a loan repayment. But every time you make a loan repayment to your policy, your bank, you have access to that. So every $100 you put into the policy per month, what it's doing is it's reducing that loan. So you're reducing the loan by $100 a month, every month, but you still get to use this 100. You didn't lose the 100. When you give $100 back to the home equity line of credit bank, that $100 is gone because it's probably just interest. When you give the $100 back to your policy only charges you interest one time a year. So you have 12 months to pay it down. Now let me go back because now all this is going to come full circle and we're going to wrap with that. Come back up here. Remember what we did here. Now we're going to do $100. Okay, we're going to do $100. There we go. Let's copy that. We're going to make $100 payments every month for 12 months. And let's see, come back over here. I got to just change some numbers here, folks. 100. I'm not the spreadsheet guru like Craig is, but I can get around and make this right. All right, so now we're making $100 payments. Okay, so total $100 monthly payment every month. And remember, what was the outcome? Well, we didn't pay 5% interest or 5.5. We actually paid less because we repaid principal in those 12 months. And that interest is only due one time a year. So we got 12 months of paying principal down in this scenario where you don't have that option when you use a HELOC. You don't have that option when you use a line of credit. But when you become your own bank, you change where your savings goes first and you apply this process that I just showed you. The same thing you're doing today. You're just writing checks to the wrong bank. You should be writing checks to the bank with your name on it. And I just showed you the basic fundamentals of how that works.
Yeah, so the one thing that I noticed that would really, really bring all of this into perspective is that 10,000 that you borrowed to pay off that credit card at 20%. People are paying $400, $500, and $600 per month on those credit cards. So how much quicker are they going to pay back that 10,000 they originally borrowed? So your numbers, as awesome as they were, explode when you realize what people are really paying for credit card payments every month. It's
Well,
crazy.
I did this intentionally, and I want to now show you because I knew that. Now, I
Okay.
kind of tricked your audience a little by showing $100 a month, but you just confirmed it without this being planned that they're actually more like for a $10,000 credit card, it's more like $500.
Yes.
So let's just run the math. So remember, you saw the impact of making the $100, which wasn't anything too great, but now let's say we got a loan of 10 grand. And we're paying $500 a month, the exact same amount you were given to the credit card. You started with a 5% interest rate. So how much are you paying to the insurance company after 12 months? 3.375. You see how fast the velocity of money works when you apply it here? This is just math, folks. This is no hocus pocus. Mathematics are amazing when you apply them in your benefit. And there it is. 5 down to 3.37 in 12 months.
Isn't that crazy? I swear, I love to watch the math work because it's not magic, it is math. And when you show people, in second, third, fourth grade math, what their money can be doing. I think that's what, the mind-boggling explosion happens, is because now you're showing realistically what's happening with people's money. And that's all people want to know, is how can I use my money in the best way possible? Again, infinite banking has become my favorite concept because it is so life changing with your money, and how you can use your money, and how you can use a line of credit to fund these policies, to use that money to now pay off your debt, then pay yourself back, and pay your line of credit. I mean, it's just so exciting to realize there's more than one way to do financing than through that bank loan that they've told us about our entire lives. So we have been literally, brainwashed. That's a big term, but you've really come accustomed to how the bank works, and the tools they wanted to teach you how to use, and
I
that's
love
making
it.
payments. That's making
And,
payments.
and the coolest thing about what we just did, that didn't involve anyone working longer, didn't involve them
Right.
working harder, and didn't involve them taking any risk. It was just changing who the money gets paid to and controlling the velocity of the interest actually given up.
Yeah, and that's it's been a big thing I've been talking about this year in my videos, is we have gurus out there calling people stupid. You're an idiot. Had you been working the second job, had you been delivering pizzas at night, you wouldn't be broke right now. But instead you chose to work an 8-hour position and spend time with your little girl that's growing up, you know.
Absolutely.
And so when we look at realistically, just me and my own situation, having three little girls, and having to work those 7/12s just so that I could, make it and get out of debt, I would trade back anything for my time with my girls, because they're grown now. And the idea of that you shouldn't be taking vacations and things like that, when they get on their own, they're not going to have time for vacations because everybody gets busy. So I want to bring to the American people that there's a better way to do your financing. And you know what? You can have your family and you can be debt free. It's just that we weren't taught how to do that together. And
Absolutely.
now that with these concepts and bringing people the hope that they want, everybody wants to enjoy their children. You just think you have to just stick them in a daycare and leave them there while you go, do these extra things. It's not about that. It's very exciting to me to be able to bring true, realistic answers to people that they can get started doing today. And guys, that's what these videos are here for, is to teach you a better way to use your money so that you can have the family time that you desire. You can take the vacations and not feel guilty about it. And I'm excited to bring it to you. I know Chris is. Chris, thank you so much for, just laying this out in elementary terms for us so that we can understand how we can use these infinite policies to absolutely, absolutely change what's happening with our money.
My pleasure. Thank you for having me on.
You're welcome. It's my pleasure to have you. And guys, if you have any questions or comments, please feel free to leave them below. You're going to see a link in the video description below where you can reach out directly to this Infinite Banking Concepts team, where they're going to teach you, show you what your own money can do in these scenarios here, just like the one you've seen here. I am glad to talk to you about this as well, because I'm excited about what this is doing in my own finances, and I'm super excited to share it with you. So feel free to reach out. I appreciate each and every one of you for watching today. I hope you're blessed by the information that you've received, and I look forward to seeing you in the next video.
I hope you guys enjoyed that. And if you did, make sure you click that little subscribe button. And also there's a little bell. Smash that bell so you're notified every time we put out new content. This video, I think, did a really good job of showing you how what you think about money is not always how it really works. It's time to learn the truth about money, and you just started the journey. So let's continue.